Real estate or stocks? For decades, people have argued over which investment creates more wealth. So today, we're putting them head to head. Two people, the same starting money, two completely different paths. And by the end of this story, you'll probably know which one is right for you. Two guys, same age, both 32, same city, same $60,000 sitting in a savings account, slowly losing a fight against inflation. Jake uses it as a down payment on a $300,000 rental property in the suburbs of Charlotte. 3-bedroom, decent neighborhood, good school district. He closes on a Thursday, picks up the keys, and drives past it on the way home from work every single day. He tells his wife, he tells his coworkers, he tells the guy next to him at his cousin's wedding, "We own a rental property now." Marcus takes the same 60 grand and puts it into a total stock market index fund. No keys, no tenants, no story to tell at weddings. He sets up a $500 automatic monthly contribution, closes his laptop, and genuinely doesn't think about it again. When his coworkers ask what he's investing in, he says, index funds. They nod politely and change the subject. Nobody's impressed. 20 years later, both of them have crossed the $500,000 mark in net worth. But here's the part that changes everything. One of them got there by building something. The other one got there by doing almost nothing. And the difference between those two paths, the stress, the freedom, the actual money in the bank after every real cost, is what every real estate versus stocks video gets completely wrong. Because here's the problem with every real estate versus stocks debate you've ever watched on YouTube. Somebody always picks a winner before they do the math. The real estate guy tells you cash flow is king and pulls up a spreadsheet that magically has no vacancy, no repairs, and no bad tenants. The index fund guy tells you compounding is everything, and conveniently forgets to mention what it felt like to watch his portfolio drop 40% in 2008. Neither of them is lying. Both of them are just showing you the version of the story that makes their argument look good. This video doesn't do that. We're going to run both sides honestly. The numbers people put on thumbnails, and the numbers buried in the footnotes that actually determine whether you're building wealth or just building stress. By the end, you'll know which investment actually came out ahead in our scenario, why the answer is more complicated than either side admits, and, most importantly, which one makes more sense for your situation. Let's get into it. Real quick, before we get into the numbers, if you're tired of financial advice that's based on feelings instead of facts, you're in the right place. Around here, we break down investing, retirement, and money decisions using real math and real-world examples, so you can see what actually works. If that sounds helpful, subscribe and stick around. We've got a lot more coming. Okay, so Jake buys his $300,000 rental property. 20% down, which is his $60,000. He gets a 30-year mortgage at 7% interest. His monthly payment comes to about $1,596. He finds a tenant pretty quickly, $2,100 a month in rent. And right there, on paper, he's making $504 a month. Over $500. Passive income. Just like that. He does the math. $500 a month times 12 months, that's just over $6,000 a year. On a $60,000 investment, that's a 10% cash-on-cash return. He calls his dad. His dad is proud. And then reality moves in. Property taxes, about $3,600 a year in his county. Landlord insurance, another $1,800. That's already $450 a month gone before anything breaks. Which, of course, things break. Year 1, the water heater gives out. That's $1,200 out of pocket. Year 2, the HVAC needs a repair. $900. Year 3, the tenant moves out in August. The place sits empty for 6 weeks. Jake loses $3,150 in rent, spends $800 cleaning it, and $400 relisting it on Zillow. Oh, and he still paid the mortgage those 6 weeks. Out of his own pocket. When you add up the real numbers, taxes, insurance, vacancy, maintenance, repairs, the random stuff that just happens to houses, Jake's actual net cash flow over those first 3 years is somewhere between $3,000 and $6,000 total. Not $6,000 a year, $6,000 over 3 years on a $60,000 investment. And that's before we count a single hour of his time. The late night texts from tenants, the Saturday morning repair calls, the hours spent vetting applications, coordinating contractors, filing taxes with a Schedule E for the first time, and paying a CPA to help him not screw it up. That's the number that doesn't make it onto the thumbnail. If this is already showing you costs that most real estate videos bury in the footnotes, do me a quick favor and hit the like button right now. It helps this video reach more people who need to see the full picture. And it takes literally 1 second. Okay, back to the money. Here's where I have to be completely honest with you. Because if I just told you about Jake's mediocre cash flow and called it a day, I'd be doing exactly what the index fund influencers do. Jake has something Marcus doesn't. Leverage. Jake used $60,000 to control a $300,000 asset. That's a 5-to-1 ratio. And while his cash flow has been underwhelming, that $300,000 house has been quietly appreciating. Real estate in the US has historically gone up around 3 to 4% a year. At 3.5% annually, Jake's property is worth roughly $356,000 by year 5. His remaining mortgage balance is about $276,000. That means his equity, his actual stake in this asset, has grown from $60,000 to around $80,000. And he collected some rent along the way. That's the real estate pitch, and it's legitimate. You used the bank's money to amplify your returns. That's not a scam. That's how generational wealth gets built in this country. Marcus, meanwhile, has his $60,000 in VTI, the total US stock market index fund, plus his $500 monthly contributions. At a 10% average annual return, which is the S&P 500's historical average, after 5 years, he's sitting at roughly $112,000. No leverage, no property, no tenants, no midnight plumbing emergencies. Just a number on a screen that keeps going up. So after 5 years, Marcus is clearly ahead in raw portfolio value. But Jake has equity, he has leverage, and he has a depreciating asset he can write off on his taxes. And that depreciation thing, that's a whole other advantage we're going to get to. We're about to get to the year 10 and year 20 numbers. And I promise you, at least one of them is going to surprise you. Make sure you're subscribed so you don't miss the follow-up video where we model exactly what happens when you combine both strategies. Hit subscribe and let's keep going. By year 10, here's where things get interesting. Jake's property is now worth roughly $424,000. His remaining mortgage balance is around $240,000, so his equity is approximately $184,000. More than triple his original $60,000 investment. His cash flow has improved because rents in his area went up while his mortgage payment stayed fixed. He's netting maybe $400 to $600 a month after all real expenses. Not life-changing, but real. He's also been deducting depreciation every year, which has sheltered a meaningful chunk of income from taxes in a way that stock investors simply can't replicate. But, and this matters, Jake has also spent somewhere between 200 and 400 hours managing this property over the past decade. That's real time. Weekends he didn't get back. Conversations he had to have. Decisions he had to make. That's real time. Weekends he didn't get back. Conversations he had to have. Decisions he had to make. He's been carrying $240,000 in debt the whole time, with a single asset, in a single zip code, with zero diversification. Marcus at year 10, his portfolio, with consistent $500 monthly contributions, is sitting at approximately $200,000 to $220,000. He put in $60,000 to start and $60,000 more in contributions over the decade. The rest is compounding. He spent approximately 0 hours managing it. He owns a tiny piece of thousands of companies across the US economy. He can sell any of it tomorrow if he needs to. No tenants required. At year 10, Jake is slightly ahead in total wealth, but mainly because of leverage and appreciation, not cash flow. If the housing market in Charlotte had stalled, or if he'd had one seriously bad tenant situation, those numbers flip. Now let's be equally honest about Marcus's side of this, because the stock market is not some smooth escalator to wealth, and anyone who tells you it is has never actually held through a crash. In 2008, the total stock market dropped 37%. If Marcus had $150,000 in his account and watched it fall to around $95,000 in a matter of months, that's gut-wrenching, and the data is very clear. Most regular investors panic sell during crashes. They lock in those losses. They buy back in after the recovery, which means they miss the rebound. The strategy works perfectly if you hold through everything. Most people don't hold through everything. There's also no cash flow. Marcus's portfolio might throw off 1.5 to 2% in dividends. On $200,000, that's maybe $250 to $300 a month. That is not replacing anyone's paycheck. And there's no leverage. Marcus used $60,000 to control $60,000 in assets. That's the trade-off for simplicity. Neither investment is a free lunch. Jake's lunch comes with a side of tenants and maintenance costs. Marcus's lunch comes with a side of volatility and the psychological test of watching your net worth swing by tens of thousands of dollars in a bad month. So, year 20. Jake's property, if he held it, is worth somewhere around $600,000. Mortgage is either paid off or nearly there. His total equity, $400,000 to $500,000. His net cash flow profit above all expenses over 20 years? Somewhere between $80,000 and $130,000. He built real, tangible wealth. He also worked for it in a way most people don't account for when they run the math. Marcus's portfolio, at 10% annual returns with consistent contributions. Somewhere around $450,000 to $500,000. He contributed about $180,000 total over 20 years. The rest, over $300,000, is pure compounding. He never lost a weekend over it. They end up in the same general neighborhood, but how they got there is completely different. Jake built something. Marcus waited for something. And the right answer for you depends entirely on who you are. Real estate wins clearly if you're in a market where rents actually support cash flow, if you have the time and temperament to manage a property like a business, if you understand leverage and you're not scared of debt, and if you want depreciation and tax advantages that index funds can't touch. Index funds win clearly if you want simplicity, diversification, and the ability to scale your investment with a few extra dollars a month instead of a second mortgage. They win if you want to sleep on both sides of the night, including the nights when something breaks at a house you don't own. And here's the thing nobody talks about. You don't have to choose. Owning one solid rental property while consistently investing in index funds is the combination that changes the math more than either path does alone. That's the video I'm making next. But before you go, the most important question you can ask about any investment isn't which one wins on average. It's this: did you include everything? Because the answer that includes everything is the only answer that actually matters. If this video gave you a clearer picture of how these two investments really compare, not the thumbnail version, but the real version, drop a comment below. Are you team real estate, team stocks, or are you doing both? I genuinely read every single one. Subscribe if you want the follow-up. See you in the next one.